But what I can say as a dead cert is those who decide to hold their assets in fiat-denominated bonds or cash or deposits are going to find that their value will get eroded either very slowly and gradually or all at once. A lot of people are saying, well, why not revalue gold at $150,000 an ounce and pay off the entire national debt? I think that's a dangerous strategy because it's going out a little bit too far into very untested territory. The figure I proposed of $15,000 would generate cash for the Treasury of $3.9 trillion. Now, that's not a terribly big number of cash relative to the national debt of $37 trillion.
The value of the US dollar against other currencies dropped about 11% in the first half of this year, the biggest decline in more than 50 years, ending a 15-year bull cycle. Historically, governments have used gold revaluations during periods of financial stress to strengthen their fiscal positions. The practice differs fundamentally from confiscation by focusing on the accounting value rather than the acquisition of new physical gold. The current interest in gold revaluation stems largely from America's unprecedented debt situation. The U.S. debt-to-GDP ratio stands at approximately 120%, a level previously reached only during the extreme circumstances of World War II. The U.S. debt spiral is now a crisis. With interest payments eating up nearly 19% of tax receipts, the government is about to roll over $9 trillion in debt. Veteran investor Clive Thompson says a gold revaluation may be the only way out. In his outlook, Clive Thompson notes the U.S. government has a hidden solution to the debt crisis. Revaluing gold to market price could release about $750 billion for the Treasury without adding a single cent to the national debt. Revaluing gold is not a signal of strength. It is a signal that other options have failed. Any attempt to reprice gold in this manner would be viewed as a tacit acknowledgement that the United States cannot grow or tax its way out of its debt spiral. It would be interpreted as an act of desperation. The U.S. has a secret trick it's already used before, in 1934. Clive Thompson says a new gold revaluation, this time to $15,000 an ounce, could generate around $3.9 trillion. That's enough to cover 10% of the national debt and 2 years of deficits, a bold but realistic move to solve America's debt crisis. Before we dive into Clive Thompson's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Let's just go back a step and look at why it could be very beneficial to the United States to revalue gold. The United States is running record budget deficits. The debt is rising rapidly, and it is likely that the interest to be paid on that debt is going to rise very fast from here. We've seen the interest expense as a percentage of the receipts, the government receipts, i.e. the taxes it's taking in, rise from 3 years ago, just 8%. In other words, they were taking in taxes of, let's call it taxes of 100 and paying 8% in interest, and the rest was used for other government purposes, to this year, 18.6%. So it's certainly more than doubled in 3 years. Now, according to not only my calculations, but the Congressional Budget Office's calculations, that number is going to continue to rise for the foreseeable future. The only comment I'll make is the CBO is almost certainly being too conservative in their numbers because they are assuming an interest rate which is unobtainable, i.e. far too low, unobtainable if you're a borrower at the moment. So the government has a large amount of debt maturing in the next 4 or 5 years. I think it's something like $9 trillion, which a lot of that debt was taken out when interest rates were 1 to 2%. And they're going to have to roll it over at higher rates, which are closer to, I'm going to say closer to 5%, although 4.2% wouldn't be an unreasonable rate at the moment. That will cause the amount of interest being paid on the national debt as a percentage of the tax take to be actually worse than this 22.6% that the Congressional Budget Office sees for the year after next. And it's going to spiral up quite a rapid pace beyond that. And there comes a point when it becomes completely unsustainable. So something has to be done to at least put the debt in check or reduce it or slow down. And I think one of the options, but I think it's a very attractive one for the United States, would be to revalue gold at a higher level than the statutory price. Now, the statutory price for gold was set in, I think, originally was set when they raised it from $25 to $35 in 1934. And then I think they raised it again in 1972 and 1973 to now $42.22 an ounce. So the gold that the United States holds is on their book at a price of $42.22. And the Federal Reserve, who does not own the gold, but has a gold note representing the gold they did sell to the Treasury, a gold note which is worth $11 billion, priced at the original price of $42.22. Now, that gold note or gold certificate is not convertible into gold by the Federal Reserve. It just represents legal tender of $11 billion, even though it's called a gold certificate. Meanwhile, the Treasury's got the gold, which they've got on their books at $11 billion, but it's really worth $700-800 billion today. If we take a market price, today's market price, I think it's somewhere between 3,300 and 3,400 as we're doing this show, might be a little bit higher in a few days. That would release $750 billion, and I'll explain how if they were to revalue it. Now, there's several ways in which this can be done, and I'm also going to get to why 3,300, 3,400 is not the right number, why a higher number would be the appropriate one, the 15,000, which I talked about. But I just start with the basic principle that they go to the current market price of gold, and then we'll go from there as to why the higher number will be better. So there's broadly speaking, two ways in which this can be done. The first one was outlined in the Bitcoin bill, Bitcoin Act, which hasn't passed into law, but basically that act specified as a subclause of the act, the Federal Reserve would tender its gold certificates of $11 billion to the United States, in other words, to the Treasury. The Treasury would then immediately revalue gold to the current price. In that Bitcoin Act, they referred to $3,300. And then the Treasury would reissue to the Federal Reserve gold certificates identical to the previous ones, but at the current market value, which would be $700-800 billion. And the Federal Reserve would be obliged, on that happening, to pay to the Treasury the difference between the value of the two gold certificates. In other words, a bit more than $700 billion. Now, the beauty of this, and by the way, this has already happened effectively in 1934 anyway, so it's just a repetition of the same old trick. Now, the beauty of this is that the gold certificates are not part of the national debt. In other words, when you see the national debt, that includes bonds issued by the government, notes issued by the government, treasury bills issued by the government, but it does not include the gold certificates. So in swapping 11 billion of gold certificates for 750 billion of gold certificates, the Federal Reserve would have to pay to the Treasury the difference, $700 billion, without increasing the national debt. In fact, the Treasury gets the $700 billion, $750 billion, and it can use that money to reduce maturing debt, and obviously, because it's revalued the gold, it will show a huge profit, at least not as much to cover the budget deficit, which of $2 trillion, but it'll cover a third of the current year's deficit, bringing the deficit for the current year looking like it's not rising as fast as it really is. The gold certificates are effectively perpetual instruments, a bit like a banknote. They're perpetual, they're zero coupon. The government pays no interest on these gold certificates, and they can't be redeemed by the Federal Reserve, not for gold, not for cash, not for anything, unless the Treasury says so. So that would help a little bit if they did it at the current price of $3,300. But what I suggested was perhaps they should choose a different number, and I suggested the right number might be $15,000 an ounce. Well, exactly. A lot of people are saying, well, why not revalue gold at $150,000 an ounce and pay off the entire national debt? I think that's a dangerous strategy because it's going out a little bit too far into very untested territory. The figure I proposed of $15,000 would generate cash for the Treasury of $3.9 trillion. Now, that's not a terribly big number of cash relative to the national debt of $37 trillion. It's about 10% of the national debt. And it's not a terribly big number relative to the amount of increase in debt they have every year, which is around $2 trillion, slightly more. So it's a little bit adventurous. But the market can absorb that extra $3.9 trillion.
In 1934, the U.S. revalued gold overnight, instantly reducing the dollar's value against other currencies. However, Clive Thompson emphasizes that today's world is different, as revaluation would ignite a massive shift in financial markets. He believes a gold revaluation to $15,000 would send silver rocketing, while even without it, silver's structural deficit points to higher prices ahead. Near-term technicals remain firmly overall bullish for both gold and silver markets. Price action has recently been sideways and choppy for both metals, but remains at historically elevated levels. Longer-term charts indicate that gold and silver have remained in solid price uptrends, dating back to 2016 for gold and 2022 for silver. All of this comes as the Fed looks set to cut rates in September, which would typically boost gold, but concerns over potential tariffs on smaller gold bars leave it in limbo. Wall Street overwhelmingly expects the Federal Reserve to cut rates next month, and Chairman Jerome Powell's speech on Friday will give him a chance to hint at which direction policymakers are headed. However, some analysts don't think a September rate cut is a certainty, and even those who expect a cut are skeptical that Powell will announce it at Jackson Hole. Let's get back to the interview.
No, I don't. I mean, the dollar will go down a little bit, but I don't think so. I mean, obviously it did in 1934 when they pushed up the price of gold by 69% in one day, and that caused effectively the dollar to be 41, I think 51% lower. I haven't got the exact figure, but in other words, the rate of the amount of pounds euro, well, it wasn't euros back then. It was the amount of pounds or Swiss francs or French francs that you could buy back then changed overnight. Rather upsetting all the bankers in Europe who suddenly found that their dollars were worth that much less. But I don't think that's going to happen in the same way today because the world currencies are not linked to gold. So back then, the French franc and the British pound, all these other currencies were linked to gold. So when you reduce the amount of gold and dollar, the dollar's worth less. But today, all the currencies are linked to the dollar anyway. So not on a peg basis, but the dollar would go down a little bit. It wouldn't make a big difference. And it certainly would not change retail prices, as a lot of people have suggested. Some people have said, wow, this would be terribly inflationary. Well, no, there's no way it's going to cause any inflation at the retail price level because although there'll be more money coming into the system, that money's going into the hands of the Treasury at the first instance. And all it's doing, as far as the Treasury is concerned, is not forcing them to borrow more money. So the money supply at the end of the day is going to stay fairly constant as the Federal Reserve and the Treasury manage the national debt between them. So the money supply isn't going to shoot up. And even if the money supply was going to shoot up, where's that money going to go to? It's going to go to financial assets. You know, if we go back into 1934, in America, the price of nothing changed because of this. The anticipation of what was going to happen changed the stock market price, but it didn't change the cost of goods in the shops. And it won't change the price of goods in the shops again this time because prices of goods in the shops are not linked to the gold, they're linked to paper money. And that's not going to change. The silver market is a much smaller market than the gold market. If they sell gold, people are going to buy, some of that money will go into the silver market, and that will accelerate the silver price to a high degree. So I think silver will do at least as much as gold. But what about if this doesn't happen and there's no special revaluation of gold? Do I think silver will rise? Well, according to the Silver Institute, we can see the supply and demand of silver since the last few years has been in deficit. In other words, not enough is coming out of the silver mines to meet the demand for industrial use and other uses. So the extra silver which is needed to meet those needs has been coming out of recycled silver. And that explains why we've seen a rising price of silver, because as the price of silver rises, more silver gets recycled to balance the books. The deficit, according to the Silver Institute, and I've got no other source to go on, is going to grow larger. The reason it's going to grow larger is that the mine supply of silver is still in decline, and the industrial usage of silver is still on the rise, especially from electronics, where it's rising very rapidly. So as that deficit gets larger and larger, more and more recycled silver, i.e. you and I melting down or taking our gold, or in this case silver, taking our silver in to be melted down, is going to have to happen. Otherwise the silver won't be there. And the only way they're going to suck it out is with the higher prices. So I think silver does go higher, whatever happens. A few days ago, before the Labour report last week, which was a terrible report from the jobs numbers point of view, the expectation was that it was about 70% probability of a rate cut in September. That immediately moved to around 90%. But since Scott Bessent spoke last night, the probability of a rate cut in September has now moved to 100%. That's according to the CME FedWatch, which does the mathematics of this. So the question is no longer longer whether we'll get a 0.25% cut in September. It's how much will the cut be? Is it going to be a quarter or is it going to be a half? And now the market, well, obviously, the stock markets are overjoyed with that news. And you saw, the Dow went up by 400 points yesterday. We're speaking today on Thursday. I don't know when you're going to broadcast, Thursday, the 14th of August. So yesterday, the 13th, the Dow went up and the Nasdaq went. They all hit, the Nasdaq hit all-time records. The S&P 500 hit an all-time record. Gold moved a little bit, but gold is in a little bit of disarray at the moment because of the events of last week regarding the possible tariffs on gold bars.
Yes, comments on that, Clive.
So one of the Swiss refiners wrote to the US Customs to say, can you just please clarify that the tariffs will not apply to gold bars? And the answer came back saying, well, probably apply. I haven't seen the text of the answer. I don't know if it's published even, but the answer came back along the lines of something like, well, 100-ounce bars and kilo bars will be tariffed, but not the 400 kilo bars. Well, of course, what's needed in New York are the 100-ounce bars, not 100 kilos. What's needed in New York are the 100-ounce bars. What's coming out of London to be refined are the 400-ounce bars. So the bars go from London to Switzerland to be refined from 400 to 100 and from Switzerland to New York. So that the fear was that 100-ounce bars would be tariffed at 39%, which immediately drove the futures to a huge premium because on COMEX in New York, there are a lot of shorts. And those shorts are consistently selling the futures. They've got the gold in London. Yep, no problem. They're fully covered in a certain sense. But they consistently roll the gold forward month after month. But suddenly there's a worry that what if they have to deliver? Up until now, the thought's been, well, I've got the gold in London. I can always deliver if I need to. But now the fear became when this happened, oh my God, perhaps I won't be able to deliver. So these short rush to cover their long position in the futures market, pushing up the futures to a very large premium compared with the spot market. And of course, there was a scramble to buy gold at the spot level. Then there was a clarification, I believe, from the president, and I haven't seen that actually, but I see it reported everywhere. There's a clarification saying, oh no, that's all a big misinformation. There won't be any tariffs on gold bars. Without having seen the text of either, and I say I don't, I've been looking for it, I don't know if it's published.
Throughout monetary history, gold has often served as a bridge during transitions between currency regimes. Its status as a neutral, non-sovereign asset makes it particularly valuable during periods of monetary uncertainty, a role it could potentially serve again if current de-dollarization trends continue. We are not predicting an imminent revaluation of U.S. gold reserves, nor would such a move resolve the underlying structural challenges facing American public finance. But the debate itself is significant. The financial system is evolving, and gold is once again at the forefront of this transformation. Are we witnessing the dawn of a new golden age? Or is this merely a short-term shiny moment for the world's oldest currency? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.